Think Florida real estate is still the American dream? Not anymore. Behind the perfect beaches and glossy retirement brochures, a financial storm is ripping through the state, and millions of homeowners are standing directly in its path. Teachers earning $65,000 are opening renewal letters showing their insurance jumping from $4,000 to $12,000 overnight. Home values are down 11% since peak, and the average Florida homeowner is being crushed by $18,000 in new annual housing costs compared to just a few years ago, while wages barely moved 4%. Nurses, police officers, firefighters, the backbone of Florida's communities, are quietly planning escape routes. The families who played by the rules, saved for down payments, and bought in safe neighborhoods are now discovering a brutal truth. Florida's insurance crisis doesn't care who you are. It hits everyone. Credit cards are maxed out to cover premiums. Emergency funds vanish in weeks. Parents are choosing between keeping the house or keeping their kids in college. And the year 2026 isn't a prediction. It's a deadline millions of families won't financially survive. So today, we're exposing the 10 Florida cities where homeowners may be forced to sell in 2026, starting with a place where waterfront paradise has quietly turned into a financial trap drowning everyday families. Number 10. Cape Coral. Cape Coral's waterfront dreams are drowning in insurance nightmares. Picture hundreds of miles of canals reflecting for sale signs instead of luxury yachts, while families who moved here for affordable paradise discover the water they loved became their financial trap. Florida's Venice has become a cautionary tale about uninsurable waterfront living. The numbers tell a devastating story. Median home prices crashed from $429,000 to $380,000, an 11% correction that destroyed equity for recent buyers. Insurance costs exploded from $2,400 annually to $9,200 for waterfront properties, while HOA fees jumped 40%. The typical family earning $72,000 faces $26,000 in annual housing costs before groceries. Cape Coral built over 400 miles of waterways that now mean astronomical insurance premiums, making waterfront properties financially toxic. For middle-class families who bought in 2021 with 5% down, the situation creates impossible choices. They're underwater while bleeding $1,800 monthly for insurance and HOA fees. Local teachers at Cape Coral High discovered their $58,000 salaries can't support homes demanding $2,200 monthly before the mortgage payment. Healthcare workers making $68,000 watch their financial security evaporate as insurance renewals arrive with 150% increases. Properties sit 118 days on market while sellers drop prices weekly. Young families who believed Cape Coral's waterways meant lifestyle and value discover those same waterways mean insurance companies classify every property as high flood risk, regardless of elevation. The dream of backyard boat docks becomes a nightmare of monthly bleeding that never stops. And if Cape Coral's waterfront nightmare feels devastating, Fort Myers shows how mainstream suburbs face identical insurance destruction. Number 9. Fort Myers. Fort Myers positioned itself as Cape Coral's more established neighbor, less waterfront, more suburban stability, better schools, stronger job market. But families are discovering that being 3 miles inland doesn't matter when insurance companies decide the entire Lee County region is uninsurable. The supposed safety of non-waterfront living has evaporated, leaving mainstream middle-class families devastated. Look at what's crushing these supposedly protected neighborhoods. Median prices dropped from $385,000 to $348,000, a 9.6% decline that wiped out down payments for recent buyers. Insurance costs exploded from $2,600 to $8,400 annually, even for properties nowhere near water, while property taxes on inflated assessed values mean another $6,500 annually. Families earning $71,000, Fort Myers' median income, discover that $26,000 in annual housing costs leaves zero cushion for the emergency's Florida living guarantees. The human impact reveals systematic devastation. Lee County teachers earning $56,000 pay $8,400 annually for property insurance on suburban homes that have nothing to do with flood zones or coastal exposure. They're spending 15% of gross income on insurance alone before the mortgage payment. Healthcare workers at Lee Health making $74,000 discover their raise over 3 years was $3,200, while their insurance costs jumped $5,800. They're going backward financially while home values crash. Young families who bought in Gateway or San Carlos Park with FHA loans in 2021 are trapped $38,000 underwater, while insurance costs consume budgets that assumed $2,600 premiums, not $8,400. When Hurricane Ian damaged roofs across the region, families discovered their policies had depreciation clauses and massive deductibles. The $18,000 roof replacement became a credit card debt they're still paying at 24% APR. Properties sit 94 days on market while desperate sellers accept offers $48,000 below asking. Fort Myers' promise of stable suburban living collides with Lee County's insurance crisis that makes no distinction between waterfront and inland. Number 8. Kissimmee. Kissimmee's proximity to Disney World promised tourism-driven prosperity, but families are discovering that Mickey Mouse wages can't support Florida insurance costs. Walk through neighborhoods 5 miles from theme parks, where service workers bought homes believing tourism jobs meant stability, only to discover the economic foundation is quicksand. The tourism marketing sold recession-proof employment, but nobody mentioned that tourism jobs peak at $45,000, while housing costs demand $80,000 in household income. Behind those tourist area homes lies financial devastation. Median prices fell from $362,000 to $325,000, a 10.2% drop that destroyed buyers' equity. Insurance costs jumped from $2,100 to $7,200 annually, while tourism jobs averaging $42,000 create impossible housing math. The typical service industry family faces $21,000 in annual housing costs on income that can't support it. Kissimmee's economy runs on tourism, which means seasonal fluctuations, tip-dependent income, and zero wage growth. The situation gets brutal for working families. Disney cast members, Universal employees, restaurant workers. They bought homes in 2020 to 2021 when prices were lower. Theme park recruiters emphasized cast member benefits and career advancement. But reality is entry positions paying $17 per hour with irregular schedules that make second jobs nearly impossible. A household with 2 Disney cast members earning $52,000 combined pays $1,250 monthly for insurance and property taxes before the mortgage payment. They're burning through credit cards while equity vanishes. Tourism schedules mean working weekends, holidays, peak vacation periods when everyone else is off. Families can't coordinate childcare. Parents working opposite shifts never see each other, and they're still falling behind. Families are listing homes knowing they'll walk away with nothing. Properties sit 89 days while sellers watch neighboring foreclosures accelerate decline. When the AC breaks or roof leaks, there's no emergency fund left. And if Kissimmee's tourism nightmare feels crushing, Deltona proves the crisis isn't limited to tourist corridors. It's destroying suburban commuters too. Number 7. Deltona. Deltona's suburban sprawl promised affordable family living between Orlando and Daytona Beach. But that so-called sweet spot has turned into a financial vice slowly crushing middle-class families. Drive through the endless subdivisions built on affordability dreams, and you'll meet homeowners who quickly discovered that hidden costs erased every bit of savings they thought they were getting. Those glossy brochures boasting easy access to both cities never mention that the reality is being stuck in the middle of nowhere, paying to commute in both directions while absorbing insurance costs tied to coastal and inland risk. The math exposes the truth. Median home prices slipped from $318,000 to $285,000, a 10.4% drop that erased equity almost overnight. Insurance premiums jumped from $1,950 to $6,800 annually, and that easy commute now costs $450 a month for Orlando workers and $380 for Daytona Beach commuters. A household earning Deltona's $64,000 median income faces $22,000 $16,500 in annual housing costs before adding transportation. Altogether, you're staring at nearly $28,000 a year before food, healthcare, childcare, or anything resembling a safety net. Teachers who bought in 2021 thought they were escaping brutal rental markets, only to discover that insurance costs now exceed their actual mortgage payments. Volusia County educators earning $52,000 spend 90 minutes a day in traffic and $420 a month on gas just to reach classrooms in Daytona Beach. Whatever affordable living Deltona advertised evaporates the moment you add transportation costs on top of skyrocketing premiums. Police officers and firefighters working in Orlando or Daytona Beach face the same trap. A Deltona firefighter earning $58,000 now spends $1,850 a month on housing and nearly $450 commuting to the Orlando station, over $2,300 before buying groceries or paying utilities. Young families who chose Deltona as a starter home stepping stone now realize they stepped into a financial pit. They're geographically isolated, losing 10 to 12 hours a week to commuting, spending $400 to $500 a month in gas, and watching property values fall like dominoes. Homes sit an average of 104 days on the market, as desperate sellers accept offers $35,000 below asking. HOA fees are jumping 35% as foreclosures hollow out budgets, creating a doom loop no family can outrun. And if you're finding value in this investigation, make sure to hit the subscribe button. You don't want to miss the deeper breakdowns coming next, because the devastation in Lakeland shows an entirely different level of crisis. One where working-class families face math so brutal, it leaves even seasoned analysts speechless. Number 6. Lakeland. This is Lakeland, the literal center of Florida, a place that promised stability, supply chain jobs, and affordable living. Families moved here believing they were choosing the sensible option, not coastal, not tourist-driven, just steady paychecks and predictable expenses. But walk through its working-class neighborhoods today, and you'll feel the weight of a very different reality. The warehouse wages that built Lakeland's growth simply cannot survive Florida's insurance shock. Economic development officials once celebrated every new Amazon or logistics hub as economic opportunity, but nobody warned families that jobs paying $48,000 a year would someday be expected to support housing costs that require $65,000 or more. What was marketed as blue-collar stability has turned into a financial trap with no escape hatch. The numbers tell the truth without mercy. Median home prices fell from $298,000 to $268,000, a 10% decline that erased equity for families who bought in 2020 and 2021. Insurance premiums jumped from $1,900 to $6,500 annually, turning modest homes into financial burdens. A typical logistics family now faces $20,000 in annual housing costs on income that barely covered pre-crisis living expenses. Amazon fulfillment workers are among the hardest hit. When the warehouse opened, recruiters advertised $15 to $17 an hour with benefits and advancement. But families quickly learned that real advancement tops out around $23 an hour, even after years of overnight shifts. Insurance benefits never came close to offsetting the explosion in property insurance costs. The schedules make the crisis worse. Warehouse shifts are irregular, and shift rotation means second jobs become impossible. A Lakeland couple, both working logistics, one on the Amazon day shift, the other overnight, brings in $56,000 combined. Yet they now pay $1,625 a month just for property insurance and taxes before even touching the mortgage. They see each other maybe 2 hours a day and somehow still fall further behind every single month. Families are maxing out credit cards simply to pay insurance premiums. Minimum payments add another $380 a month to budgets already stretched beyond breaking. Tax refunds evaporate instantly into premium payments, leaving nothing for inevitable AC failures in Florida's heat, a $10,000 crisis that pushes many households into foreclosure territory. Homes sit on the market for 112 days or more, with sellers walking away from deals empty-handed. Young families who used FHA loans are tens of thousands underwater, unable to refinance, unable to sell, and unable to keep up as insurance resets climb every renewal cycle. Lakeland exposes the fragile reality of Florida's working-class economy. When insurance jumps and wages don't, even the most disciplined families drown. And if Lakeland's working-class devastation feels overwhelming, what retirees in the villages are facing will shake you. Because when insurance costs consume Social Security checks, there's no backup plan, no overtime shift, no second job, just a retirement dream collapsing in real time. Number 5. The Villages. The Villages marketed itself as retirement paradise, but seniors on fixed incomes are discovering that paradise has property insurance costs that destroy retirement budgets. Picture manicured golf cart paths winding through neighborhoods where retirees who saved for decades watch insurance premiums consume Social Security checks while home values crater. The retirement marketing promised active lifestyle on a budget, but the budget part evaporated when insurance companies decided Florida was uninsurable at reasonable rates. Fixed incomes collide with exploding costs. Median prices crashed from $385,000 to $348,000, a 9.6% correction that wiped out equity retirees' plan to access for healthcare. Insurance costs exploded from $2,300 to $8,200 annually, while fixed Social Security and pension income can't absorb the shock. The typical Villages retiree faces a crisis. $685 monthly insurance premiums on $3,200 in fixed income leaves, almost nothing after HOA fees, utilities, and rising healthcare costs. Seniors who sold homes in expensive states and moved to Florida for affordable retirement are trapped watching decades of savings evaporate. A retired couple from New Jersey sold their $650,000 home, paid cash for a $340,000 Villages property in 2020, believing they'd secured retirement with $310,000 in the bank. Now that property is worth $320,000. They're paying $8,600 annually for insurance that was $2,400 when they bought, and their nest egg is being drained at $24,000 annually to cover insurance increases and rising healthcare costs. Retirees discover that Florida's lack of state income tax is meaningless when insurance costs triple and home values crash. The tax advantage now feels like a cruel joke, saving $4,000 annually on state income tax while paying $6,000 more for property insurance creates a net loss that accelerates yearly. Healthcare needs increase with age, but insurance costs consume the budget allocation for medical expenses, forcing retirees to choose between keeping the house and getting knee replacement surgery Medicare won't fully cover. Properties sit 95 days on market, while desperate sellers accept offers $50,000 below asking. The Villages' age-restricted communities mean younger buyers with financing don't qualify, creating illiquid markets where cash buyers lowball offers knowing sellers have limited options. The retirement dream transforms into a financial nightmare, where seniors spend golden years watching life savings evaporate. Number 4. Ocala. Ocala's horse farms and rural charm promised escape from urban chaos, but families are discovering that country living comes with insurance costs that destroy the dream. Picture rolling pastures where equestrian enthusiasts bought properties for affordable acreage, only to watch insurance companies declare rural areas uninsurable at reasonable rates. The marketing emphasized land ownership and agricultural lifestyle, but what families discovered is that insurance companies assess wildfire risk, lack of fire hydrants, and volunteer fire department response times, then multiply premiums, making rural dreams financially impossible. Rural isolation meets insurance reality. Median prices dropped from $289,000 to $261,000, a 9.7% decline that wiped out equity. Insurance costs exploded from $1,850 to $6,300 annually, while the rural location means volunteer fire departments and limited emergency services that insurance companies cite to justify astronomical premiums. Families earning $58,000 face $19,500 in annual housing costs, plus the reality that rural properties take twice as long to sell. What seemed like more space for less money becomes more insurance costs with fewer buyers when you try to exit. Families who purchased small horse properties with dreams of agricultural exemptions discover that insurance companies don't care about tax classifications. They assess wildfire risk and lack of fire hydrants, then triple premiums or cancel policies. A family that bought 5 acres with a modest home and barn space for 2 horses now pays $6,800 annually for property insurance, $2,400 for separate barn coverage, and discovers the agricultural exemption saves them $850 in property taxes while costing them $4,000 more in insurance. Wells, septic systems, and dirt roads that seemed charming during purchase become liabilities when insurance adjusters visit. The adjuster notes, unpaved road means delayed fire truck response. Well means no fire hydrants. Septic system means no municipal infrastructure support. Nearest fire station is volunteer-based with 12-minute response time. Each observation justifies another premium increase that pushes monthly housing costs beyond what rural incomes can support. Young families who moved from Tampa or Jacksonville for affordable space realize the isolation means commuting costs that weren't factored in. A couple earning $58,000 combined, maybe one working in Gainesville, the other commuting to the Villages. They're spending $520 monthly on gas for work commutes that become suffocating when combined with $6,300 annual insurance premiums. Properties sit 127 days on market, while sellers face brutal reality. Rural buyers are scarce, financing is difficult for properties on wells and septic, and insurance requirements kill deals. Families are abandoning equestrian dreams and accepting offers $45,000 below asking. And if Ocala's rural nightmare feels overwhelming, the crisis in Sarasota will shock you about premium markets where luxury positioning collides with insurance reality. Number 3. Sarasota. Sarasota's cultural sophistication and Gulf Coast beaches promised premium living, but families are discovering that premium locations mean catastrophic insurance costs that destroy financial security. Walk along Siesta Key's famous white sand beaches and see for sale signs multiplying like storm warnings, while families who paid peak prices discover their paradise became a financial prison. The marketing emphasized world-class beaches and cultural capital of Florida. But what professionals discovered is that world-class insurance premiums destroy 6-figure salaries just as effectively as working-class budgets. Premium markets create premium devastation. Median prices crashed from $485,000 to $438,000, a 9.7% correction that wiped out hundreds of thousands in equity. Insurance costs exploded from $3,200 to $11,500 annually for properties near water, while property taxes on assessed values mean another $8,000 annually. Families earning $95,000, well above median income and supposedly comfortable, face $32,000 in annual housing costs before utilities or maintenance. You're looking at 33% of gross income consumed by housing alone, which violates every financial planning principle. Professionals who relocated for quality of life discover that quality comes with insurance costs consuming 15% of gross income before the mortgage payment starts. A doctor at Sarasota Memorial Hospital earning $185,000 pays $14,200 annually for waterfront property insurance, $9,800 in property taxes, and watches her $620,000 home value drop to $565,000, losing $55,000 in equity while paying $24,000 annually just for insurance and taxes. Families who bought in 2021 with 10% down are $75,000 underwater, while bleeding $2,100 monthly just for insurance and taxes before the mortgage payment. The cultural amenities that justified premium prices become irrelevant when insurance premiums force families to choose between keeping the house or funding college accounts. Sarasota's renowned theaters, galleries, and restaurants lose their appeal when monthly housing costs demand lifestyle sacrifices that eliminate discretionary spending. Properties sit 103 days on market while sellers drop prices weekly. A Longboat Key property listed at $895,000 in January now sits at $825,000 in November with 0 offers, while the seller calculates that insurance renewal in February will hit $16,800 annually. The Gulf Coast location that drove prices up now drives insurance costs into impossible territory. Any property within 2 miles of water faces premiums that make ownership financially irrational. Families are accepting offers $80,000 below asking, losing their entire down payment just to escape. A couple that bought at $520,000 with $52,000 down in 2022 is now accepting $445,000 offers, which after realtor commissions means walking away with essentially nothing. But the devastation in Miami-Dade will leave you speechless about Florida's largest metro market, where entire neighborhoods are becoming uninsurable. Number 2. Miami-Dade County. Miami's international glamour and economic diversity promised stability, but the reality is families getting crushed by insurance costs that make the city unlivable for middle-class residents. Picture Brickell condos gleaming in the sunset, while families in Kendall and Homestead calculate how much they'll lose when they're forced to sell in 2026. The international business marketing emphasized global gateway and economic opportunity, but what middle-class families discovered is that Miami's economy serves wealthy internationals and tourists, not the teachers and nurses who actually keep the metro functioning. America's most unaffordable metro just became impossible. Median prices dropped from $565,000 to $515,000, an 8.9% correction that wiped out equity for families who stretched to buy. Insurance costs exploded from $3,800 to $13,200 annually for single-family homes, while condo insurance crisis adds another layer of devastation, turning high-rises into unsellable financial disasters. The typical family earning $78,000, Miami's median income, faces $35,000 in annual housing costs, plus the reality that high-rise condos are becoming uninsurable. You're looking at 45% of gross income consumed by housing in a market where groceries and basic expenses already cost more than most U.S. metros. Teachers who bought modest homes in West Kendall or Cutler Bay discover their insurance jumped from $3,200 to $11,800 in just 2 years, while home values crashed 9%. A Miami-Dade public school teacher earning $54,000 pays $11,800 annually for property insurance on a home that's lost $48,000 in value. She's underwater while spending 22% of gross income on insurance alone before the mortgage payment. Healthcare workers at Jackson Memorial or Baptist Health are underwater on mortgages while paying $1,650 monthly just for insurance before the mortgage payment. A registered nurse earning $82,000 sounds comfortable until you realize that $13,600 annually for insurance plus $9,200 in property taxes means $22,800 before the mortgage on a home that's worth $62,000 less than what she paid in 2021. Her comfortable salary becomes barely surviving when Miami cost of living demands another $38,000 annually for basic expenses. Young professionals who believed Miami's international economy meant stability realize the job market doesn't provide wages to support post-crisis housing costs. The finance and tech jobs pay well by national standards. $95,000 feels like success. But Miami housing costs demand $140,000 to live sustainably. Properties sit 96 days on market, while desperate sellers accept offers $95,000 below asking. The condo crisis adds unique devastation. Condos with insurance costs exceeding $20,000 per unit annually create forced sales where owners walk away. A Brickell condo owner paying $18,000 annually for building insurance plus $3,800 for personal coverage discovers her unit value dropped from $420,000 to $365,000, and special assessments for another $32,000 are coming. She's abandoning a $42,000 down payment. Miami's international reputation becomes meaningless when insurance companies declare entire neighborhoods too risky to insure. Number 1. Tampa Bay Metro. Tampa Bay's explosive growth and economic diversification promised sustainable prosperity, but the reality is millions of residents calculating escape plans as insurance costs and declining values create a perfect storm of forced selling. Picture Bayshore Boulevard's waterfront mansions and Brandon's suburban sprawl equally devastated by an insurance crisis that makes no distinction between rich and poor. Everyone's getting crushed by math that doesn't care about your income level or how responsibly you planned. Florida's third largest metro faces ultimate devastation. Median prices crashed from $398,000 to $362,000, a 9% correction that destroyed equity for hundreds of thousands of recent buyers across Hillsborough, Pinellas, and Pasco counties. Insurance costs exploded from $2,800 to $9,800 annually for average homes, with waterfront properties hitting $15,000 to $18,000 in annual premiums. The typical family earning $71,000, Tampa's median income, faces $28,000 in annual housing costs, while wages grew just 4% since 2022. Housing costs increased $12,000 annually, while household income grew maybe $2,800. The gap is mathematically impossible to close. Nurses at Tampa General earning $75,000 are underwater on mortgages purchased in 2021, bleeding $1,850 monthly for insurance and property taxes before mortgage payments. A Tampa General ICU nurse who bought in Riverview in 2021 for $345,000 now owns a home worth $318,000 while paying $9,200 annually for insurance that was $2,600 at purchase. She's $27,000 underwater with insurance costs that jumped $6,600 annually. And her nursing salary increase over that period was $3,200 total. The math is impossible, and 2026 is when her emergency fund runs out. Even teachers in Hillsborough County schools discover their $58,000 salaries can't support $24,000 in annual housing costs, plus living expenses in a metro where groceries and utilities consume another $22,000 annually. A Hillsborough County elementary teacher with 8 years' experience earns $54,000 and pays $8,400 annually for property insurance on a Brandon home worth $298,000 at purchase and $272,000 today. She's underwater by $26,000 while paying 15% of gross income for insurance alone, before the mortgage payment or property taxes. Young families who bought in Riverview or Valrico with FHA loans are $45,000 underwater with no equity cushion when the AC breaks. A young family, both parents working, combined income of $78,000, 2 kids under 10, bought in Valrico in 2021 with 3.5% FHA down payment. They're now $38,000 underwater while paying $9,600 annually for insurance. And when the AC unit failed last July, they had to finance the $8,500 replacement on a credit card at 23% APR because their emergency fund was already drained. They're trapped in a debt spiral that accelerates monthly. Properties sit 89 days on market, while sellers accept offers $70,000 below asking. Tampa's economy added 45,000 jobs in 3 years, but median household income grew just 4%, while housing costs increased 65%. Families are burning through retirement accounts and maxing credit cards, knowing 2026 brings another insurance renewal cycle they can't survive. A Hillsborough County family earning $82,000 has already drained $18,000 from 401k accounts to cover insurance premiums. They're calculating that they have maybe 8 more months before forced selling becomes the only option that doesn't lead to foreclosure. This is where the American dream dies in Florida, when working families who did everything right get crushed by insurance costs nobody predicted. Finally, behind every Florida sunset postcard and vacation brochure, millions of middle-class families are making devastating calculations about 2026. Teachers, nurses, police officers, firefighters, the people who keep communities functioning, are discovering that their Florida dream became a financial nightmare with no escape route that doesn't involve massive losses. The ultimate reality hits hard. Insurance costs tripled while home values crashed, creating a perfect storm that destroys equity and makes housing unaffordable simultaneously. Families who bought in 2021 to 2022 are underwater on mortgages while bleeding cash reserves to cover insurance premiums that exceed their mortgage payments. When insurance costs $9,000 annually on a median-priced home and values dropped 10%, recent buyers have zero equity and mounting monthly costs they can't sustain. They're trapped between two impossible choices: keep bleeding money knowing it ends in foreclosure, or surrender now and lose everything. So, the 2026 projection isn't speculation. It's families calculating how long cash reserves last before forced selling becomes the only option. Tax refunds that should fund family vacations are consumed entirely by insurance premiums. Credit cards are maxed covering basic expenses after housing costs consume 40% of gross income. Emergency funds are drained in 3 months. Retirement accounts are being raided to cover current housing costs, creating a future crisis that compounds the present disaster. This is happening now, and 2026 marks when millions run out of runway. The families making these calculations aren't irresponsible. They're people who saved for down payments, qualified for mortgages, bought in stable neighborhoods, and did everything financial advisors recommend. The system failed them through insurance policies nobody predicted and market corrections that destroyed equity. And if you found this investigation valuable, subscribe to Uncover the Cities as we expose disasters hiding behind the marketing campaigns. Hit the bell for notifications when we reveal which California cities are facing identical forced sale scenarios as insurance costs explode statewide. Our next video reveals Texas cities, where property tax explosions are creating the same forced sale nightmare, proving this isn't just a Florida problem. It's a housing crisis spreading across every Sunbelt state. The investigation continues. The disasters are spreading. Stay informed. Subscribe.